In 2022, Carvana stock was left for dead. And yet, in 2023, the stock is up over 300%. One consideration is that nearly 70% of their float is short, meaning that if the business inflects and starts generating lots of free cash flow, you might have all these short sellers become forced buyers. And if you have these forced buyers all of a sudden start having to buy the stock, limited supply, a lot of buyers, then you could see a parabolic move even higher than the 3%, 300% we've seen so far year to date for Carvana stock. One of these short sellers is Kerrisdale Capital, who earlier reported, "We are short Carvana," included a report. They described them as nothing more than a poorly run auto retailer. They continue in this report talking about how Carvana is running on empty. They think the shares are worthless. We view the equity as a zero. Talking about investing at the current levels is a worse deal than buying a clunker from a slick used car salesman. So the question is, who's right? Is it the short sellers, or is it the investors that are taking Carvana stock higher? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. I'm going to share my personal opinion on whether or not I would get involved on the short side or the long side with regard to Carvana. The short conclusion is that it's a very tricky situation, and I would personally rather avoid these types of situations and look for much easier investments. Look for, as Warren Buffett describes, the 1-foot hurdles that you could feel comfortable with investing. But let's dive into the argument that Kerrisdale Capital is making and sort of the rebuttal that management might have. So looking at an overview of what is Carvana, you're talking about a business that is tapping into a huge industry, 800 billion plus in used car sales in the United States in 2019. If you look at the top auto retailers, you're looking at a few percentage of the market. So it's extremely fragmented. Most consumers do not like buying used cars because of the haggling process. And so this is a market ripe for disruption. And you look at what Carvana has done, it looks like they are disrupting the market. You look at their historic growth, they've gone from just a few thousand units to over 400,000 units. You're looking at going from just a little bit in revenue to 12 billion in revenue. You're looking at steadily improving gross profits and steadily improving adjusted EBITDA margins, though never really getting to profitability, even during COVID when, used auto prices spiked higher. Why is Carvana winning? Well, I think it's just a better experience. You have around 40,000 vehicles online in the US that you can easily shop with. Very easy to sell or buy a vehicle. It's not like you're dealing with this haggle with a used car salesman about, oh no, it's this price, it's this price, and it's painful. Here it is. It's a fixed, this is it. This is the price we'd buy your car. This is the price you could buy one of our used cars. We've reviewed it, and very simple, very straightforward. And it's also very convenient. Not only do most customers get their financing through Carvana, which then Carvana sells the loans to another party, but you can have the car delivered to you. You can have the car that you're selling picked up. You can easily go to one of these car vending machines, which is pretty neat to look at. So clearly a differentiated player, it looks like, and that's part of the reason why they're winning. 2022, however, was a challenge for them. They talk about being overbuilt relative to sales volume, and we're starting to see challenges such as used car prices take a hit, as well as higher interest rates. And so you did see this downtick in profitability in 2022 that got, part of the reason why the shares got absolutely crushed. But during the first quarter, things started rebounding as management, hiked their fees and was looking to say, hey, we need to get to profitability. That's really important. As I scan through their latest news, and this is a feature, a recent feature from AI Ticker Chat, which leverages cutting-edge artificial intelligence to help you analyze stocks. First month using AI Ticker Chat is free. So looking at this news feature, which is just rolling out this week, looking at the latest headlines, one of which drove the stock higher is management announcing that they were looking at an improved second quarter 2023 outlook. They're talking about being positive free cash flow in the periods ahead. And they're talking about, look, we need to get to positive adjusted EBITDA, then to get, significant positive unit economics. So that means positive free cash flow and then growth. So they are focused on getting to positive free cash flow, not there yet, but heading in the right direction. And management also announced that they had a sizable loan sale during the quarter that helped with their economics. Kerrisdale would say, hey, that's a one-time benefit. It doesn't really reflect their ongoing unit economics, and maybe they did this to pump up the stock to issue stock. That's what Kerrisdale insinuates with their report. Another headline that I noticed that I think is super important is this announcement of a termination of an exchange offer for new debt from a range of 9 to 12%. This is particularly alarming because management tried to refinance $1 billion of their debt. They have several $billion in debt, around $6 billion plus due in the coming years. And management said, well, we're not really sure if we're going to have the money, let's say in 2025 when one of the tranches is due. So let's get ahead of it and issue really expensive debt. So prior debt cost maybe 5, 6%. Now they're issuing debt closer to 9 to 12%, 9% if it's in cash, 12% if you can get paid in kind. So in theory, your obligation grows in value if they ever repay it. And unless there's some sort of bankruptcy, which is what the short sellers are implying. And this is alarming when you see your cost of capital jumping like this. And then, by the way, the notice, this notice is about a termination where the bondholders were rejecting the termination, saying, hey, yeah, we have a 5% bond that's due, 5-6% bond that's due in the next couple of years, 2 years. We would rather get paid back than take on a new bond that's paying 9%. So bondholders are not really sure about the long-term viability of this business when you see that type of rejection. That is a warning sign. And there is a point, a clear point that Kerrisdale is making, which is the liquidity is tight for this business. They have under $500 million of cash. They have over $6.5 billion of debt. As the cost of financing this debt moves higher, this is definitely going to be tougher for a business that's still unprofitable. Kerrisdale sees that Carvana could be paying over $250 million in interest payments in the fourth quarter alone this year. And they think the only reason why they're talking about better than expected results is because they want to push the stock. They want to have to sell more stock to effectively refinance their balance sheet, get more cash on their balance sheet. So where does Carvana stock go from here, given all these different data points? First, just last week, I bought more of a stock that I think has over 300% plus upside potential that I called out to my subscribers at unrivaledinvesting.com. I also expect to raise prices soon, so now's the time to act if you'd like to lock in a favorable rate and take charge of your investment journey. In full disclosure, this is not financial advice. So looking at where could Carvana stock go? I think one perspective is let's look at what management thinks. What does management think their long-term economics could be? And so I'm looking at this in, once again, 2022 wasn't great. Revenue growth of only 6%. First quarter revenue was terrible, 25% decline. You see that their profitability, it's got better in 2021 with favorable auto pricing, but then collapsed lower, still negative. Long-term management is targeting EBITDA margins of 8 to 13%, 8 to 14%, let's say long-term. Once again, they're nowhere near that. But even if they achieve this, which once again, that requires a lot of assumptions, there are still going to be capital expenditures for, let's say, new, car vending machines. There's going to be interest expense, which has moved higher significantly and right now is a couple of percentage of their revenue, and potential taxes if they become profitable. So you're looking at an unproven business model with maybe low single-digit profit margins, if they ultimately deliver. So that could be a bull case, which is that if they get to this long-term case that management's talking about, maybe you get to like 3% profit margin, maybe higher. If you're at closer to 3%, after everything profit margins, then your stock, even after this run-up, is like 10 times earnings. And so then if you're like, hey, this is a disruptive business, they're going to be able to self-finance, which they're nowhere near doing, and that's a key risk, that they can't finance themselves, and you're starting to see pushback from the bondholders, then, but once again, if you assume they could get to that free cash flow and they could easily refinance their debt and they were generating meaningful, profits, in that situation, investors might say, hey, this is really cheap and you could run the stock up even higher, plus the short sellers, being forced to cover, in which case you get another buyer for the stock. So that is the sort of the bull case, that you could have significantly higher stock if management executes and gets to their long-term targets, which once again, they're nowhere near, especially when you look at their first quarter results, which, looked at a 25% drop in revenue, but their, adjusted EBITDA margin did improve a bit from where they were last year. I personally look at this and I'm thinking, man, they were offering huge discounts to their bondholders, effectively saying, hey, we will repay your bond at, a 15% discount. So 85 cents on the dollar, or 63 cents on the dollar, 66 cents on the dollar for a bond due in 2027. And we're offering to replace it with 9% paper. And the bondholders rejected this. And so I'm thinking at this point, first of all, this is just way too hard for me looking at Carvana stock. Like, I look at this and the blow-up risk is just way too high. I think Kerrisdale has a very fair point that the equity, at least based on what the bond market is pricing, could get wiped out. That is super valid point based on what you're seeing with what happened. You know, the bond market rejected this offer of 9% paper to refinance effectively some of their upcoming maturities. So I think in order for Carvana to work, you really just have two paths ahead. One is you have a path where the markets go back to where they previously were, where it's like, hey, free money, and interest rates are really low, and you get lenders that are more willing to lend, and you get equity, shareholders that are willing to participate in equity offerings. So maybe you see Carvana announce billions of dollars in stock sales, which, keep in mind, it's only a $4 billion stock, so that's not super palatable, I'd argue. But once again, that's a path where they can do okay, but it depends on the kindness of strangers. It depends on friendly capital markets. And it would require incredible execution to get from significantly unprofitable to, let's say, a couple percentage in after-tax profitability, which they're nowhere near. So I look at this and I'm inclined to agree with Kerrisdale that it just has tremendous challenges ahead. I personally, even if it rips higher, they're just easier investments in one's journey to make, where you can find a business that already proven their profit margins, trades at a low multiple, and is growing. Whereas you're looking at this and doesn't have the balance sheet risk, and you're looking at this and this just has all these, red flags all over it. And so I just don't like the heartburn that I would get from this. I just wouldn't sleep well, even if it works out. Now, I wouldn't, something like this, I could revisit if they started, executing from a profitability perspective. Oh, you were able to pay down your debt from free cash flow? Then great. Then I might revisit it. But at this point, it's just simply too hard for me. If you have a different perspective on Carvana stock, would absolutely love to hear it in the comments below. Thanks so much for tuning in to Unrivaled Investing.